Continuing on, we're now going to get into more detail with respect to accounting, some of the very basics. And these are basics that you must come to understand clearly if you're going to succeed in accounting. And in fact, there are certain things, as with any language, you must memorize. There's no other way around it. There's certain things you must memorize. And we'll get to those at the appropriate time. So our next slide, we have some things that you must know, some basics of accounting. First of all, we're going to talk about the financial statements later, but you have to know what is an asset, what is liabilities, and what's owner's equity. Well, to put it in these terms here, and then I will simplify them. Assets are resources that a company has, and resources they expect that will produce future results, future benefits. So, think of a simpler way to put it is assets are things a company owns. And you're not going to own something in a business unless you expect it to produce some benefit in the future. So technically, assets are resources or things a company owns that they expect will produce future benefits. So a company may buy a building, buy furniture, carpeting, buys supplies, buys land. Again, these are assets, and the company owns them. These are resources that can be used to produce future benefits. Liabilities are, in layman's term, liabilities are like debts. A debt. Technically, it is a claim that someone outside the company has. A claim or right. So if a bank lends money to a company, that bank then has a claim against the company and has a right to be paid the money it loaned you. Equity are the claims of those who are inside the company. Okay? So if you invest money in a company and buy stock in it, you have a claim, usually equal to at least what you've invested, hopefully. Now, I'm going to make all this simpler with the help of the next slide. On this next slide, you see assets equals liabilities plus owner's equity. Everything a company owns, assets, were either financed with money outside the company, such as loans, or investor money, equity. That's it. Everything a company owns, it acquired either through a combination of, or exclusively, but typically a combination of money borrowed plus equity or money that's already in the company that's owned by the investors. Think of it this way. You see the formula at the top, the equation here? Assets equals liabilities plus owner's equity. Think of it buying a house. You have a house. Let's say you have a $200,000 house. That's your asset, $200,000. You borrowed $150,000 mortgage, that's liability, plus you put 50 grand of it your own. So the $200,000 house equals the $150,000 mortgage liability plus your $50,000, which is your equity. This is the basic equation. This is the accounting equation. You must memorize it. You must know it completely and understand it. So, if you go back to your elementary school days or middle school days, maybe, Look at this equation. Assets equals liabilities plus owner's equity. So what does assets minus liabilities equal? If assets equals liabilities plus equity, then assets minus liabilities would be equal to what? You look at the numbers here at the bottom, and the answer should be very straightforward. I'll let you figure that out. I'll let you answer it, and hopefully from there you'll be able to answer the question on an exam. Now, here is the equation again. Assets equals liabilities plus equity. But let's open this up. Let's open the equity section up. The equity section is, and we're talking about a sole proprietorship, a company owned by one person. You have the capital that the owner put in, money the owner put into the business, excuse me, to start it, minus any money the owner took out for personal use, plus any revenue the company earned by selling stuff or selling services, minus the expenses. Now, look at the last two items. Revenue minus expenses is your net income. So if you sell $1,000 worth of services and you have expenses of $800 and your net income is $200 then. Let me say that again. If you have revenue or sales of $1,000 and you have expenses of $800, then your net income is $200. So what is the equity? If you own a company, what is your equity? It's the money you put in minus what you take out, plus any net income you may have, which is the result of sales minus expenses. Think about that. Now, I also want to bring to your attention, net income could also be a net loss. If your expenses are greater than your revenues, you're going to have a net loss. So for instance, if you have revenues of $1,000 but expenses of $1,300, then you're going to have a $300 net loss. But I want you to keep in mind that just for the purposes of this chapter, the equity section has been expanded. Later on, you'll see how net income, revenue minus expenses, is done very separately, and the net income is carried over to the equity section. Right now, we are including revenue and expenses in the equity section for illustration purposes. But in reality, what happens is that revenue minus expenses, that's done separately on a very separate financial statement, and the results, net income, is added to equity, or net loss is subtracted from equity. Keep this in mind, though. Excuse me. So let's move on to the next section. We're going to analyze, I think, about 11 or 13 business transactions using this equation. Please pay close attention. You need to study this. Just don't let this be the first and last time you hear or the last time you go over this. You must understand this. Excuse me for coughing, clearing my throat. Anyway, let's say there's a person named Charles Taylor or Chaz Taylor. This person invests, excuse me, invest $30,000 to start a business called Fast Forward. Now, cash is an asset. It is something that the company owns. It owns cash. It belongs to the business. So cash goes up. The amount of cash increased from 0 to 30,000, and therefore the equity, the part that the investor owns, namely Mr. Taylor, also goes up. So let's take a look here and see. Okay. As you can see, we have the equation assets equals liabilities plus equity. So $30,000 of assets and $30,000 of equity. Assets equals liabilities plus owner's equity. Liabilities at this point is 0. So 30,000 equals 0 plus 30,000. So both sides of the equation equal. Okay? Now you see already they've listed in advance some other assets. Supplies, again, something a company will own that will provide future benefit. Equipment, and on the liability side, accounts payable. Now accounts payable means that this company bought something on credit and has yet to pay for it. And accounts payable. So for instance, you might buy some supplies on credit. Then that becomes an accounts payable to you, to your company. A payable has yet to be paid. It's a liability. It's a debt. A note is an official, in writing IOU. And accounts payable tend not to be in writing. It's just an understanding that it's an informal, unwritten agreement that you're going to pay me in 30 days. A note payable, notes payable means that we put it in writing with an interest rate and a due date. So a note is more formal, if you will. But again, it has to do with a debt. A payable is a debt. You've yet to pay it. Someone extended you a loan or allowed you to buy something on credit. Oh, I'm sorry for this coughing. Okay. Next transaction. This Mr. Taylor buys supplies, office supplies, and pays cash for it. So cash as an asset went down, but supplies, the asset, went up by the same amount. So let's take a look at what happens here now. As you can see, now when something's in parentheses, it means it's being subtracted. So cash started out at 30,000. He spent $2,500 of it. So cash is now $27,500. But supplies went up by the same amount. So 30,000 minus 2,500 plus 2,500 is still 30,000. And nothing happened on the equity side. You didn't borrow any money. You didn't buy anything on credit. So that's 0 on the liability side, rather. And the equity remains the same. So pay attention to this. Only changes took place were on the asset side, but the changes zeroed out. It's like putting $2,500 in one pocket, or taking out of one pocket and putting in another one. It's the same pair of pants. So it doesn't change the exact total. Next, this person, the company bought equipment for $26,000. They're both are assets, though. Cash is an asset, so is equipment. So cash went down, equipment went up by the same amount. So as you can see here, again, cash was reduced by $26,000. Now you only have $1,500 in cash. You have the $2,500 in supplies, and you have $26,000 worth of equipment. Add up those three assets and you come to $30,000. Nothing happened on the liability side. You didn't borrow any money. You did not buy something on credit. And the equities remained the same, unchanged. Okay. Now let's get to the fourth transaction. This company purchased supplies on credit. Didn't pay cash for it. Did not pay cash for it. It bought it on credit. And by the way, and let me do this here now. Some books use the term on credit or on account. Same thing. It's the same thing. Buying something on credit is the same as buying it on account. It's just a different term. Okay? So assets increased and your debt or liability increased also by the same amount. So let's take a look. Supplies went up by $7,100 and so did the debt or liability, accounts payable. So now you have $9,600 worth of supplies. So $9,600 plus $1,500 plus $26,000 is $37,100. Your $30,000 in equity plus the $7,100 in accounts payable also equals $37,100. So both sides of the equation are the same. They're equal. That's why I call it an equation. And what you do to one side, on the asset side, we increased it by $7,100, and we also increased liabilities by $7,100. Now let's move forward and let's look at revenues and expenses and withdrawals. These three things here impact equity. They impact equity. And they could impact assets too, but as you'll see, they impact equity first and foremost. So let's take a look here. This company is called Fast Forward, and it provides consulting service. So Mr. Taylor is a consultant, and he provided consulting services to a customer who paid him immediately. Paid him $4,200 immediately. So cash went up as an asset, right? And so did revenue. Revenues, keep this in mind, revenues increase equity. Expenses decrease equity. Revenue, if revenues go up, equity goes up. If expenses, and don't let this confuse you, expenses decrease equity. So expenses may go up, which means which means that equity goes down. And you see that in a moment or two. So notice this. Cash went up $4,200, and so did revenue. And revenue is part of equity. So $30,000 plus $4,200 plus $7,100 is $41,300. And that's the same amount on the asset side. Cash went up. Cash increased. He performed a service and the person paid him cash. So it was an increase in cash and it was an increase in sales or revenue. So both sides went up by the same amount. Okay. Sorry for that phone call. I don't know if you heard it or not, but anyway. Now let's look at expenses. Paid rent $1,000. Paid salaries to employees $700. Notice this. Cash went down. You paid $1,000 in cash for rent. You paid employees $700 in cash, payroll. Okay? So cash went down by $1,700. But notice now, don't let this confuse you. Rent expense went up. The expense went up, which caused the equity to go down. Salaries expense went up. It went from 0 to 700. But expenses caused equity to go down. So don't get confused. Revenue goes up, equity goes up. Expenses go up, equity goes down. Let me say that again, because students often get confused here. If revenue goes up, so does equity. If expenses go up, equity goes down. And that's why these arrows are pointed accordingly. Okay? And you can read this information here at the bottom too. It says the same thing I just said, but just in a different way. So let's take a look at it. Here we can see the cash went down. You paid out $1,000. You paid out $700. Expenses also went up, which causes equity to go down. That's why $1,700 is in parentheses. So assets were reduced by $1,700, and so was equity. So we're still in balance, $39,600. Okay? Now, we're going to introduce you to something else that's new. Here, this company earns money by providing consulting services and also rents out part of the building. So, this company provided consulting services on credit. In other words, he performed the service but did not get paid immediately. He's going to be paid later. That's what we call an accounts receivable. He has yet to receive the money. In other words, he performed a service on credit. The customer did not pay him immediately. The customer is going to pay him later. So as far as fast forward, the company or Charles Taylor is concerned, that's an accounts receivable, means I've yet to receive the money. So if you have a company and you sell something to a customer on credit, then you will record that as an accounts receivable. Means you have yet to receive the money. And by the way, one company's receivable is another company's payable. Think about it. If you sell something on credit to another company, you're going to record it as an accounts receivable on your books. They're going to record it on their books as an accounts payable. Again, it's the same way. If you lend me $50, you're going to record it on your books as a receivable, and I'm going to record it on my books as a payable. Now, with that in mind, again, as you can see here, accounts receivable is an asset. Why? How is that so? When you lend somebody money or perform a service on credit, they owe you. You have a right. You have a right to receive that money. That right is an asset. That claim is an asset, something you own, and therefore is considered an asset. So, accounts receivable went up, and revenue, even though he performed the service on credit or on account, you still count it as a sale. So equity went up because consulting revenue went up. Rental revenue went up. And when he rented out part of his building on credit, did not get the rent immediately, going to get the rent later. That's why it's a receivable. So, but rental revenue went up. See, in accounting, and we call it accrual accounting, you record a sale when you deliver the goods and services. You don't wait till you get paid. If you recall earlier slides, one of the 4 principles is called revenue recognition. A sale is recognized. A sale takes place once you perform the service. You record it as a sale then and there. You don't wait to record it as a sale when you get the money. You record it as a sale once you have performed the service or delivered the goods, whichever the case may be. That's a very important concept. It's called the accrual basis. The accrual basis means that you record revenue when the service is performed, whether you get paid then or there or not. So, with that in mind, as you can see here, let's look at this. $1,600 plus $300 is $1,900. So receivables went up by $1,900, and revenue went up by $1,900, as you can see on the right-hand side of the equation. So the equation is still in, both sides are still in balance. Okay? Assets equals liabilities plus owner's equity. You have $41,500 worth of assets, and you have $41,500 worth of liabilities and equity. Later on, the customers pay you. They pay you for the consulting services of $1,600, and they pay you the rent. So cash went up, and your receivables went down. They no longer owe you. They no longer owe you. So that wiped out the receivables. So let's take a look. Cash went up by $1,900, $1,600 plus $300. And therefore the receivable also went down. That's why it's in parentheses. And the other side of the equation remains the same, untouched. Now let's look at transaction number 10. Remember when Mr. Taylor bought on credit $7,100 worth of supplies on credit or on account? Well, he didn't pay the whole amount, the whole $7,100. He's paying $900 toward that, what he owes. So cash went down because he paid $900 cash toward the bill, but his debt also went down too by the same amount. So let's take a look. Cash went down by $900, and so did the payables. So instead of owing $7,100, now he owes $6,200. Cash went down by $900, the liabilities or debt went down by $900. So the equation, again, is still in balance. Number 11, the owner says, okay, I've done some business. I want to take out, I need $200 for personal use. So cash went down and withdrawals went up. And don't forget, withdrawals reduces equity. Keep this in mind. Withdrawal, when the owner withdraws money for personal use, that reduces his equity. Okay? Expenses also reduce equity. So let's take a look at that. Cash went down by $200 and withdrawals went up by $200, but withdrawals, like expenses, reduce equity. You need to keep this in mind. Yes, withdrawals went up, which means equity went down. Just like if expenses go up, equity goes down. Now, when revenue goes up, so does equity. Okay? So keep that in mind. And so, what do we have here? Well, all these 11 transactions are summarized on this page right here, this slide. Now, let's make sure we're in balance. We see here the balance at the very bottom, cash. We're left with $4,800 in cash. No receivables because you got paid. $9,600 in supplies. Add that, and plus the $26,000 in equipment, and we have $40,400. $40,400. Now let's go to the other side of the equation. The liabilities are what you owe, your debt as a company, $6,200, plus the $30,000 in capital that he invested, plus, or rather, minus the $200 he took out, plus the $6,100 in revenue or sales, minus $1,700 in expenses, also equals $40,400. So both sides of the equation match. They equal. Everything's in balance. Okay? So now I want to stop this right now. This is part 2. And we're going to pick up part 3 separately on a different link. But anyway, and this is rather awkward for me. I got to try to get out of here again, but I'll learn to do this. This is all somewhat new to me too. But we're going to stop the recording now.